I want everybody to know that there are ways, there are methods that you can use to reduce what your tax burden is. The not so great news for a lot of people is that they're not incredibly simple. We're going to get into some of the details today. If you're a business owner, things that you need to be contemplating, things that you need to be talking to your CPA about to try to help save yourself hundreds of thousands of dollars a year in taxes. And we're going to talk about ways that you can be sheltering income from taxation using retirement plans. The retirement plan thing here is very important. Everything that we're going to review today is going to be an ERISA covered plan. Okay? An ERISA covered plan. That means that it's all qualified. It has creditor protection associated with it. So if you are a small business owner, or just a business owner in general, or a major corporation, there are different types of tax shelters that can be established. You have qualified plans, ERISA covered plans, and then you have non-qualified plans like deferred compensation. The biggest difference between the two, because both can allow you to shelter a significant amount of income from taxes in the current year, but the non-qualified plans, they are subject to creditors. They are balance sheet items for your corporation. Now, you can put a lot of money in there. I remember when I was getting my CFP a number of years ago, and my instructor, Mr. Brett Danko, shout out Mr. Brett Danko. Actually, one of my junior advisors right now is doing the crash course, the cram course for the CFP exam. But I remember him talking about these non-qualified plans, and he always said you can stuff it like a pig and you can put as much money as you want to in there. However, if you get sued, if your business gets sued, they can come after that money. So you can shelter a lot in the non-qualified plans, but it is subject to creditors. The ERISA covered plans, the qualified plans, they have a lot of creditor protection built in. So if you are a physician, if you are if you're a contractor, if you're a builder, and you're in an economically sensitive business, you may be killing it right now, but there were plenty of people back before the financial crisis that were crushing it, and they may have had a lot of tax problems. They may have gone down the road of, I'm going to have a deferred comp plan, and I'm going to put a tremendous amount of money in it, not pay taxes on it right now. And their business starts to fail, and all of a sudden the millions of dollars that they put in there that they thought were for them, sorry, that's going to the bank. Should have gone for a qualified plan first. So that's what we're going to talk about. We're going to talk about qualified plans. Okay. So let's dive in here. Now, there are a handful of things that you are going to be focused on when it comes to designing a plan, or when you're working with an advisor. They're going to tailor a financial or a retirement plan for tax shelter purposes to your business. All of the tools are going to be the same. There are certain types of plans that we can work with, and we're going to talk about some of those today. But every business is unique. And because every business is unique, we need to understand certain key elements of that business in order to recommend a plan design that is going to be optimal for the business owner or owners, and then other key individuals that are going to be impacted by the plan. So the first thing that is one of the key things around a plan design is what they call considered earnings. This is effectively how much money you make. Let's say, for the purposes of today's discussion, that we're talking about W-2 wages exclusively. If you're a solo practitioner somewhere, then maybe income that goes to your Schedule C can also be included for this. But for the purposes of today's discussion, we're going to be talking about W-2 wages only. Now, if you tuned in for one of our tax shelter workshops that we did back in December, we talked about how with the advent of Section 199A, the qualified business income deduction, that has prompted many small business owners, schedule or S corporations, to raise their salary in order to get a larger Section 199A deduction. And what that is going to permit them to do is not only get a larger deduction, but it's also going to increase the ceiling of the amount of money that they can shelter in these retirement plans. And we're going to see that later on in our discussion today. But your considered earnings or considered wages are your W-2 earnings that you have in a given year. And the maximum level of considered earnings that can be counted towards retirement plan contributions is $360,000 in 2026. So even if you make well over that, 360 is the cap. 360 is the cap. The next thing is the demographics. What's the makeup of your business? How many employees do you have? How old are they? How long have they been there? What are the duties of these folks? All of those things are going to be important when we're talking about plan design. Next is eligibility. Who gets to participate, or when is somebody eligible to participate, I should say. And so eligibility is something that's going to be written into your plan document. If you are in the manufacturing business and perhaps you have a lot of turnover in your workforce for people who are on the line, then maybe you don't want to let everybody come into the retirement plan that you're creating from day one. Maybe they need to be there for 12 months before they're eligible to get in. So this is the threshold that we're going to establish that somebody's got to step over in order to participate in the plan. Next is vesting. So any salary deferrals that somebody puts in out of their own paycheck, always immediately vested. Some company contributions, and we're going to look at some of these, are also going to be immediately vested. What that means is if somebody's in your plan and they leave, any dollar that is vested, they're going to be able to take with them. But company contributions may be subject to vesting. There are different vesting schedules that are out there. Some of them can be as long as into year 6. We may talk about that a little bit. So any salary deferrals, though, money that an employee puts in to a company-sponsored retirement plan, their money is vested from the beginning. Some of the company contributions that could go in may also immediately be vested. Some of them may not be. The last is discrimination. Now, I talked a little bit at the top of our discussion today about this qualified plan versus non-qualified plan. We're talking about qualified plans, these ERISA covered plans. They have very strict non-discrimination rules. The non-qualified plans do allow for discrimination. You could say this person is in and this person is not in with a non-qualified plan. With a qualified plan, you don't necessarily have the ability to do that. For the most part, let's say that you don't have the ability to do that. If you have a 401k plan, it's going to have to cover everybody who is eligible. If you have a profit sharing plan, we're going to get into this in a second, you have to cover everybody as long as they meet the eligibility threshold. So there are very strict non-discrimination rules for ERISA covered plans, but they do allow for permitted disparities. And that line, that clause in quotes right there, is one of the most important things that we are going to look at in plan design when we're looking to optimize these plans for the benefit of our business owner. Because you want to be able to put away as much as you can for yourself, and we want to take care of our employees, but you're not going to put away the same amount of money for them as you are for yourself. And it's those permitted disparities that are going to provide for that. Okay. We're going to talk briefly about 3 different types of plans, and we've hit on a couple of them already. So, defined contribution plans are 401k plans and 401k plans with profit sharing features. And so uh, these plans are going to be driven by, or the benefits down the road are going to be a function of how much in the way of contribution has gone into them and what the investment performance is. But a 401k plan, most people know what it is. It's going to allow for somebody to put their salary in there, some company contributions as well as it could be a matching contribution. There are also some non-electives. We're going to talk about that here in just a second. But just keeping it very simple, somebody can put $24,500 of their own earnings into a 401k plan this year if they are under 50 years old. If you're over 50, there are catch-up contributions available for another 8 grand if you're between 50 to 60 and then over 63. So you can get up to 32.5. If you're between 60 and 63, they have a super saver catch up where you can put in an additional $11,250. But so 401k plan, I want you to think salary deferral. And again, salary deferral is going to be fully vested from the jump. Whatever money you put in, it's yours. You leave, you go somewhere else, you're taking that money with you. Now, profit sharing plans, the ceiling for how much money can be contributed to them is meaningfully higher than what you're going to get in a 401k plan. You can put up to $72,000. That is the IRS 415 limit. That's the threshold that they will allow you to put into defined contribution plans in total. So if you're a small business owner, you could have a 401k plan with a profit sharing plan that is bolted onto it. You could also simply have a profit sharing plan, no 401k plan. The 401k plan, again, it allows for salary deferral. Employees can put their own money in as well. Profit sharing is company contribution only. So it's money that is only coming from the company side. Now, if you're a business owner, this is one and the same, but there is an accounting difference. One of your 401k is going to be salary reduction, money that's coming out of your W-2 wage. The profit sharing plan is going to be something, a contribution that you make from the company account. And you're also going to make it likely one time a year. So the salary deferrals that go into a 401k plan, they're happening on a recurrent basis. Every month, you've got a certain percentage or dollar amount that you're withholding going in there. The profit sharing plan is something that you are likely making that contribution one time a year. And here's the good news. If you are a small business owner and you're looking for ways to be able to reduce your taxable income for 2025, it is not too late for you to establish a profit sharing plan for 2025 here in 2026, as long as you haven't already filed your return, which the likelihood is, today's the 12th of February, probably not. So you have all the way up until you file your corporate return. And by extension, if you're the business owner, your personal return, you've got all the way up until you file that company return to be able to implement and make a contribution into a profit sharing plan. But again, the ceiling for those contributions much higher than what you have in a 401k plan. Now, the other difference between the profit sharing plan and the 401k, even though they're both defined contribution plans, is that the company contributions that are funding the profit sharing, they are almost in every scenario that I've done, they're going to be subject to a vesting period. It's money that you're putting aside to reward your employees, but this is the golden handcuff. This is one of the golden handcuffs. We're going to put more money in there for you, and you're going to see that you have this balance available. But you can't just up and leave with it at any point in time. No, you got to stay and earn it out. And this is where, for the plan design that you're writing out for your company, how do you want to do that? You're able to have what they call a graded vesting schedule, which is where it's going to vest a certain percentage every year. The maximum you can do on a graded vest is where it would be fully vested into year 6. So you get 20% a year, right? But after year 5, in the beginning of year 6, the entire thing would be fully vested. You can also do what they call a cliff vest, where none of it is vested until a particular point in time, and then boom, it's all vested. The longest you can do for a cliff is 3 years. Then this is where the numbers really get interesting. When you add on a defined benefit plan, in particular the cash balance plan, these have become much more vogue since probably 2010. I saw a stat a couple years ago when I was at a conference uh, about how many cash balance plans were established in a given year, and the first cash balance plan was actually established by Bank of America for their own team, and but from that point in time, and maybe kind of through the 90s, there was some adoption of cash balance plans, but it wasn't a whole lot. And then it's probably 2010, very early days of the Obama administration, the number of cash balance plans just went vertical. All of a sudden, it seemed all the small business owners were looking for ways to shelter substantially more income. And that is where you go do it, where you still have creditor protection, but you're able to shelter hundreds of thousands of dollars a year into a cash balance plan. Now, again, your company contributions only going into the cash balance plan. So you can't put any of your own salary into the cash balance. The other big difference here in a cash balance plan is that the the investment the investment direction and the results fall to the company, to the plan itself. There are actuarial return assumptions built into a cash balance plan. Now they're pretty low, so you're looking to make 5% a year in that cash balance plan. But because the return assumption is so much lower than what you would have for, say, a 401k or a profit sharing plan that can be invested in the stock market over time, the government allows you to put away a lot more money in there. So if you're a financial advisor and you understand this idea of discount rates, you're a finance person, you know that you're if you have a smaller denominator, if your discount rate is lower, then to achieve a certain value in the future, you got to put more money into it. That's the concept behind the cash balance plan. So nobody does a cash balance plan with the intention of, I'm going to put away hundreds of thousands of dollars a year and I'm going to have it invested the same way as my 401k or my profit sharing and try to kill it. No, you've got a very stable investment portfolio for the cash balance plan. But the main reason that you're doing that is because you want the tax shelter. You want to be able to make those contributions year over year. Okay. Let's keep moving here. I'm going to touch on this idea of safe harbor. You may have heard this idea of safe harbor. It means different things in different areas, right? But for retirement plans, a safe harbor is a provision that your retirement plan could have that's going to exempt you from liability or really discrimination testing. And it's something that most of these plans that we're helping people set up or even prevalent in the largest corporations in this country, they are top heavy. They allow the highest income earners to be able to shelter as much as the IRS permits them to be able to shelter. But in order to do that, they have to meet certain requirements. On the 401k side, there are a handful of formulas that we see more commonly. The first two are the ones that are the most pervasive, and that is what they call a safe harbor match. So that is where the of a employee contribution, the first 3% that person puts in, the company has to match it dollar for dollar. The next 2%, they match it 50 cents on the dollar. So if that person puts in 5% of their own, they're getting 100% of the first 3, then 50% of the next 2, which is another 1, they're getting 4. That's the maximum company contribution that they're receiving as a match in a safe harbor match. If they put in 10, they still get 4. If they put in 3, they only get 3. If they put in 2, they only get 2. So safe harbor match, very common. Okay, but it exempts the plan from what they call ADP, ACP testing. The other option there that we see a lot of, and we do a lot of, is this safe harbor non-elective. And so that safe harbor non-elective says it doesn't matter whether you're putting money into the plan or not. So in the safe harbor match, if you put in 0, you get 0. But in the safe harbor non-elective, you're getting 3% regardless of your participation in the plan. You can put in 0, you're getting 3. You can put in 3, you're getting 3. You can put in 20, you're still getting 3. The next two, and we're starting to see these a lot more, is what they call a QACA. It's the Qualified Automatic Contribution Arrangement. And effectively what that means is that there's automatic enrollment into a plan. And so when you join a company, as soon as you meet the eligibility threshold to come into the plan, they're automatically going to enroll you. Now, you can opt out, but they're automatically going to enroll you at a certain deferral percentage, and then it's going to escalate over time to a certain level as well. So the match for a QACA is a little different. You get 100% or dollar for dollar on the first 1% you put in, and then 50% on the next 5. So the max out of pocket for a corporation is only 3.5% versus 4 for the safe harbor match. The non-elective is the same. It's 3% regardless of your participation. But here is why these are becoming more pervasive. And it's because the QACAs, they actually allow for the company contributions here to have a vesting period. We are going to see so many more of these that, corporations have been moving away from, obviously, the benefit plans, the pension plans that everybody's grandparents had from the 60s and 70s, that we don't have that anymore. Now all these companies have 401k plans, and they've decided people are going to save their own money for retirement. I don't know if that's working out too great for us as a country or not. But now companies have some money that they are going to put into these plans because, they want to take care of their employees. The other side is they're obligated to. The government requires them to put aside a certain amount of money. But again, those first two here, the safe harbor match and the safe harbor non-elective, fully vested from the jump. As soon as you're eligible and those contributions start going in from the company's side, you can bounce and you can take all of the company's money with you. And the company could be going, what gives? I just put this money in there for you. The QACA allows them to say, I'm going to put, some money in there for you, but you got to stay for at least 2 years in order to keep it. Otherwise, it's a forfeiture. Now, all of these safe harbor contributions, these company contributions, we're talking about matching or a non-elective contribution that comes from the company side. This all paves the way for adding on other plans, for bolting on these profit sharing and these cash balance plans. And this is part of what the TPAs, the third-party administrators, would call your gateway contribution. This is the amount of money that the IRS is going to require that goes in for the rank and file, the non-highly compensated people. You've got to put away a certain amount of money for them in order to max out for the highly compensated. Gateway contribution. Okay. All right. I want to show you a couple of examples. Spencer, let's pivot over here. Let's pivot over here. All right. I'm going to show you a couple of illustrations. This is where some of the stuff can get a little bit boring, but I want you to stay with me. So we talked about the things that were key elements of plan design. And we talked about things like demographics, wages, all those sorts of things. So what we're looking at here is a hypothetical example that I had one of my TPA partners run for me, where I've got a business owner. I've got a business owner who's 60 years old, who's paying himself $120,000 in salary. He's got 5 employees who work for him. This is ABC Metal Fabrication Company, by the way. So he's got a machinist, 2 fabrication techs, somebody working in the office, and a warehouse manager. So in this scenario, so this AA, so here's our actual age, right? Everybody who works for him is younger than he is, or she is, right? So the age is important, right? There are 2 ways that the IRS allows you to discriminate in these plans. May not necessarily be who you can cover, but this permitted disparity idea, we can discriminate based on ages or wages, right? When we line both of those up, it can be very powerful. But we're going to look at examples of how you have to toggle and shift your plan design based on how old you are as the business owner, how much you're paying yourself, and then how old is your staff. Okay. So just going to look at a couple of examples here. So in this example, our business owner is 60 years old. He's paying himself 120 grand as a W-2 wage, which is less than what he pays his machinist. Okay. We're going to avoid that. We're going to avoid looking at this for right now. He could have a 401k plan already set up, and because he's over 50, he can put away $32,500 in that 401k plan. Presume right now he doesn't even have a profit sharing. So a lot of people say, I already have a 401k plan. I'm glad you got started, but you're still missing a lot of opportunity. If this person doesn't amend anything for themselves as far as what their salary level is, if they're not bolting on a profit sharing and a cash balance plan, just for themselves, they're missing out on putting away another $167,500, which is what the IRS would allow them to do if they added on a profit sharing plan and a cash balance plan. Now, in order to be able to max out, put as much money into these profit sharing and cash balance plans for themselves as they want to, they've got to hit this gateway contribution. Okay, the easiest way that they're going to achieve the gateway contribution, they're going to do this safe harbor non-elective. If you do a safe harbor match, the company contributions that you put in may not count towards your gateway contribution. So if you're looking to stack plans in order to stack up your tax deferred contribution, you don't want a safe harbor match. You want a non-elective. But so we see here that our business owner, he actually doesn't receive a safe harbor non-elective contribution. He doesn't get 3% of his salary here. He's excluded here. But we're going to have to put away some more money for our staff in order for our owner here to be able to shelter away another 120 grand for himself in cash balance and 47.5 in the profit share. Here's one other thing I want to call your attention to. I told you that these plans are non-discriminatory. Anybody, if somebody's eligible, they're going to participate in the 401k. They're going to participate in the profit sharing plan. And every single one of these employees over here, they have a line item for whatever they're putting in salary deferral, but they're getting their safe harbor non-elective, they're getting a profit sharing contribution. Okay. Not everybody is getting one over here in the cash balance plan. The rules for cash balance is a little different. As a general rule, the IRS says that you've got to cover 40% of your payroll census. And so you don't have to have everybody covered in the cash balance plan. And so traditionally, what we do is we work with you on your plan design to determine if there are key people that you're looking to cover with the plan. But oftentimes, what the actuaries are doing here is they are finding a way to maximize the amount of money that can go to the owner and minimize the expense that goes, or the contributions that go to everybody else. Now, here's what I want to focus on, and then I want to show you how this evolves over time. We just had like a cacophony of numbers up at the top of the page. We're going to keep it real simple. There's a pie chart that breaks down of all of the money that went into these plans. Okay, there was a total amount of contributions. $223,675 was the amount of money that went into all of these plans. Okay. And about 75% of it was for our owner in this particular scenario. Okay. He's the principal here. And so that's not bad. That's not bad. What I always like to tell people is whether you adopt these retirement plans or not, there is a pie chart for you. But instead of saying principal and non-principal, it says your name and state and local government over here. So you pick your poison. In this scenario, for our business owner, he's keeping 75% essentially of all of these contributions from the company side for his own benefit, and he's providing the remainder to his staff, presumably with some vesting associated with that. So he's saying, I'd rather give this money to my employees. I'd rather have it go for their benefit than give it to Uncle Sam or whatever state that I'm living in. And then here's the other thing. As a business owner, the contributions that you put in for your staff, this is a more tax efficient way for you to compensate them. Because if otherwise you were going to be giving them a bonus, then you're going to have to pay your side of the FICA tax on that. There are no FICA taxes due on the retirement plan contributions you make on their behalf. So you're going to save yourself 7.5% on as far if the choice was, I'm either going to put it in these retirement plans or I'm going to bonus it to them, you're going to save yourself 7.5% by putting it into the retirement plans versus bonusing it out to them. Now, I want to pivot. We're going to go back. I want to look at a couple others because I want to show you this sliding scale of what is important in terms of maximizing these contributions. So the first one that we looked at there was this guy is paying himself 120 grand, okay, and he's 60 years old. Now all of a sudden, if I say, all right, let's go all the way up, and I'll show you if he's paying himself $360,000. Okay. Now he has maxed out. He's gotten to the considered earnings maximum now. And not only is he older than his staff, but he's now put some significant distance between himself and his staff as far as his considered earnings are concerned. Right? That sounds redundant. But what that's going to allow him to do is put away between his 401k, the profit sharing plan. We said that the max that can go in there, right, if you're under 50 is 72 grand. If you're over 50, in this case, we're talking about $80,000 between those two. But a cash balance contribution of $300,000. He's just sheltered $300,000 from paying taxes right now. And I want to, the punchline here is that when I look at my chart, let's go back. Here we go. Here we go. Go back to my pie chart. We've gone from the business owner receiving 75% of all the contributions to 88. This is a home run. Anytime that I'm running illustrations for a business owner, 75 is a good, litmus test. If it's 75, it may be, if you may want to proceed there. If the business owner is going to retain 75% of those contributions. If it's more than that, then yeah, you might want to look at. You get into the mid 80s, come on, right? What are you waiting for? You're sheltering a lot of money. You're sheltering $347,500. I mean, that is a ton. That's just the company contributions. That's not including your salary deferral that you put in, right? This person's saving $380,000 a year in their retirement plan, not paying taxes on that in the current year. They're probably going to save themselves, I don't know, $150,000 a year in taxes by adopting that plan. So this is why the income that you pay yourself, why it matters. Okay. I'm going to show you one more example of where having the income disparity, where it matters even a little bit more. And that's if you're actually younger than some of your team. Okay. That's when you need to have that permitted disparity. If the age is not working for your benefit, now you've got to jump up the income side to make a real difference. Okay. So here we are, right? We've got our business owner. He's now 55 in this example, not 60. And so his machinist is older than he is, and we're paying him a larger W-2 than what we're paying ourselves. Okay. So when we roll the tape here and we see that now, because I'm a younger business owner than my staff and I'm only paying myself 120 grand a year, only 68% of the contributions are now going to me. Only 68. But let's flip the script on that. And we're going to say, all right, well, the one thing that I can control is maybe what I'm paying myself. I'm 55. Now I'm paying myself 360. I'm at my maximum considered earnings now. I'm sheltering $342,000 total between my 401k, profit sharing, and my cash balance plan. And I'm at 85% now. 85% of all the contributions are now benefiting me. But the lever that I had to pull to make that happen is I had to have my W-2 number go up. That's why your plan design and the way that your advisor and your accountant are going to work together to optimize this for you is so important. There are a handful of levers that the government is going to allow you to pull to shelter as much money as possible that's going to have creditor protection. But you got to know how to pull those levers. I see way too many business owners. We're good with that, Spencer. I see way too many business owners still that are paying themselves lower salaries because they are trying to minimize the amount of money that they're going to pay in FICA taxes. That's their focus. And so I'm trying to take the lowest W-2 that I can, and then I'm just going to have a K-1 distribution for the rest. You are missing the forest for the trees. You are missing the forest for the trees. Not only are you probably not optimizing your Section 199A deduction as a business owner who's an LLC or S Corp partnership, not only are you missing that, but you're hurting yourself in terms of the level of tax shelter that you have available. So we've got to make sure that we are optimizing these things for you. Make sure that you're paying yourself enough, because you're going to put the odds ever more in your favor when you do that. So, all right, we're about ready to wrap up here. The last thing that I'm going to say is that if you have a retirement plan already, a 401k plan, that's something that you need to be reviewing on a 3 to 5 year time horizon, right? Our standard operating procedure for our 401k clients is we want to make sure that we're reviewing that plan with that cadence to make sure that the plan is still priced appropriately, that we're helping, that the plan is performing adequately. And so as the trustee of these plans, you have fiduciary obligations to be able to do these things. And we want to help make sure for all of our plans, our job is to try to help our clients stay clean. How are we helping them address the fiduciary obligations that they have? They can outsource a number of these things. Are the investments performing? What's the service model? And at the end of the day, how much is my plan costing me? And is what I'm paying for my plan, in by extension what my participants are paying for the plan, is it in line with where the industry is right now? Far too many retirement plans that we see, they were set up 10 years ago, 15 years ago, and it was done as, I just need something simple, I need to get it going. And so you get it going, but it's out of sight, out of mind. You don't necessarily have any quote unquote problems with it. But fast forward 15 years, and all of a sudden you've gone from there wasn't any money in it to now there's a couple $1 million in it, but you're still getting charged as if the plan doesn't have much money in it. You're not actually benefiting from the scale that your plan allows. And not only is that hurting you, probably as one of the larger shareholders in that 401k plan, but it's also a risk to you as a trustee, that your duty to your employees, to the participants in there, is to make sure that you have a process to be able to review these things. So when we do these benchmark audit reviews for our clients, this is something that we want to keep in their file. We're going to give to them. And if the Department of Labor ever comes and knocks on their door and asks them questions about their retirement plan, this is going to satisfy a lot of those questions. They have done their duty in terms of reviewing that plan and making sure that it is working for the benefit of their employees. So, all right, that is it for today, everybody. Thank you so much for tuning in to this episode of the $1 Million Question. If you have any questions about your retirement plan, if you're a small business owner and you're going, you know what, I just know that I'm going to get wrecked in taxes for this year, for next year, going forward, I need some help. Shoot us an email, info@reveillewealth.com. We'll have a discussion with you. We can help you formulate some ideas around your plan design. We can connect you with a third-party administrator who can run these sorts of illustrations that we looked at today. You may want to know, what does that look like for my business? Shoot us an email, let us know, and we'll be happy to run one for you, because this is the time. There is a pie chart out there with your name on it. And it either says your name and your employees' names, or it says your name and the government, right? Which one of those pie charts do you want to choose? Okay, that's the $1 Million Question for today. Thank you, everybody. I'm Stephen Weitzel. I will look forward to seeing you here next week on the $1 Million Question. Take care. We'll see you then.